So I've been trading price action for 14 years and today I'm sharing 9 price action patterns with entries, with targets. I will show you exactly how to place the best stop loss, the best targets and everything else that you need to know to find the best trades using only price action. So let's start with one of my favorite ones, and this is called the breakout buildup. And this is a pre-breakout pattern, and if you are into breakout trading and if you want to find great trend following trades, you need to know about this pattern. So what does it mean? So first of all, you can see the market has been already trading in a range. The market broke out of a range and here's the first consolidation. And here is now the breakout buildup. Let's zoom in and let's find out what is so specific about this and what is so unique about it. And this is how it looks when we zoom in, and you can see that the market broke out of this blue line that we have seen previously. It moved into a new low, retested the previous lows now as resistance, and then the market moved back into the lows. Now, how does the market move back into the lows? It moves into the lows and really sticks to the level. Whereas previously you can see the market try to push higher. You can see here was a huge bearish rejection candle. So although there was some interest from buyers, the buyer interest was immediately rejected. The sellers completely took over. And after this huge red candle, the market really stuck to the level. And this is a pre-breakout build-up signal that you will often find. And this really indicates that there is a lot of selling pressure and the buyers are not able to get the price away from the level. So what you want to do is you want to wait and very carefully wait for the market to actually break out. And it is very important that when you are trading a breakout strategy, that you're always waiting for the market to fully break out of the level that you've identified as your breakout level. One of the biggest mistakes that many traders make is when they want to trade breakouts. Obviously, patience is something that many traders struggle with, and then they will get and jump into trades much too early, and then you're often running into fake outs. Although not every breakout will succeed, you can significantly improve your chances of finding a good breakout if you wait for the market to fully close beyond the breakout level that you have previously identified. And you can see when it comes to targets, and I will come back to targets and talk more about targets later in the video, what you want to do is to keep it simple, look left and look at where are the biggest areas of support and resistance. Where has the market struggled previously? And you can see here are 2 areas which are great for target placement, and it really depends a little bit on your level of aggressiveness. Are you okay with a little bit more risk? Then you could go for the level that is a little bit wider. There's a good chance that the market could have bounced at the first level, so choosing the wider level really has to compensate you for the additional risk. So make sure that you understand that. When it comes to stops, what I always teach my students and my traders is try to protect your stop loss behind some technical barriers. Technical barriers could be support and resistance, could be highs and lows, it could be a trend line, it can even be a moving average. So in this case, if you're trading a breakout, what you really like to do, first of all, your stop loss must be behind this breakout level. This is a great first technical barrier, and you can see we could have also tucked our stop loss here very nicely behind the price action to give it an extra level of security. Obviously, nothing works 100%, but those are some great starting points for your breakout trades. And I want to talk more about stops and targets in just a moment. So let's talk about the second price action pattern. And some people call it a wedge. This is also how you can read price divergences. And as I will come back to this many times, context is really the key when it comes to looking for price action patterns. So what do we see? We see that the market is coming from an uptrend, so the market has been moving higher pretty strongly here, but something has changed then here in the price dynamics. Whereas previously the market was easily able to make higher highs and higher lows, here the market started to struggle. Yes, you can see the market did make higher highs, but this is obviously not really convincing. This is not really showing you or giving you a lot of trust in this uptrend, right? It shows you that the market is really struggling and the buyers are almost not able to push the price higher. And you can see we are very nicely able to define here the wedge. We can connect the highs, we can connect the lows, and then we get a wedge. And again, very important that we actually wait for the market to break out. Here, for example, you really want to make sure that this is where you look for an entry. You want to make sure that the price is fully closing outside of the level. Even better if you see that the market is closing outside with a strong momentum push. You can see the market previously dipped outside of the level, but it pulled higher. Although this would have given you here a little bit of an early entry, this is where most traders run into problems. If you want to be early, this is an additional risk in trading. And in my experience, what I would always recommend, be a little bit late, but you have more information on your side. And again, where do you put your stop loss? You want to hide your stop loss behind support, resistance, and technical barriers. And here we can very nicely hide our stop loss behind the previous low and also behind the trend line. And it's also here the high of the recent price action. So this could have been a very nice place to hide your stop loss. For targets, we have a few options. We can look left to find some area of support and resistance. You can see here's probably some flip zone that the market struggled with in the past. Previous resistance turned into support. And you can see the market is also struggling here with, so in the comments below. All right, let's talk about price action setup number 3, and this is called the fakie. And many traders, when I talk to them, they always complain that they're running into fake breakouts and they don't know how to deal with them. And we can actually build a trading strategy around fake breakouts. However, context really matters in this case. And the more context you can structure around your trade, usually the more significant the signal is going to be. So let's start here at the top, at the left, and see what we have. The market is in a clear uptrend. Here was a big push to the upside. Then the market moved sideways for a long time. And you can see when the market moved back into the previous highs, it wasn't really convincing. The market tried to break out, but the price action was rejected. And you can see we have here a pin bar that is moving lower quite significantly. You could also draw here a trend line if you want, and then you could also have a little bit more context. So what does the fakie tell you? The fakie tells you that after a strong trending market, the price and the buyers try to break out higher and continue the trend, but it wasn't successful and the market immediately failed. And whenever you see that the market is not able to continue a trend, especially if it's in a mature trending context, that's really where you want to pay attention to. And how do you trade that? There are a few options. Either you could, after you see the pin bar, drop to the lower time frame. You could draw here a trend line and trade on the breakout. The stop loss, to secure a stop loss, where would you put it? Where would it make sense in this context? It would make sense to secure a stop loss at least behind the highs here, because you don't want to run into a second stop run. At this point, there's still a chance that the market may come back and retest the previous highs. So you want to make sure that your stop loss is protected, and protection usually is here above the highs. So give it a little bit of room. Don't just put it at the top of the pin bar, because it's very likely and it's very common that the market is actually going for stops again. Another fakie, and here again, we want to always look for context. So here on the left, we have a huge spike to the upside, right? Then the market died down for quite a while, even made a little bit of a retracement to the downside. However, the buyers came back, drove the price back higher, tried to make it break out, but the price was only able to dip higher by a little tiny amount, and then immediately was rejected. And how was the market rejected? With a huge engulfing candle. So we have the failed breakout after already here this strong move against this huge push. So it looks like the market was not really interested in actually continuing this upside push. It could be that this was maybe just news related and there was a news item coming out and this was just an impulse, but the impulse, there was no follow through, which is very common after news trading. And then you can see we can really nicely stack the confluence. We have the failed breakout, we have the big push to the downside, we have the engulfing candle. And again, where do you put stops? You could hide it again above the highs. You really want to make sure that your stop loss is out of the way, so that even if there is a little bit of a retracement and the market is trying to challenge the highs again, your stop loss is not as vulnerable. And again, to the left, where you look for targets, usually at previous highs and lows. So here would be an obvious choice for a potential target. Let's talk about flags, and I really love flags. Flags are among the most profitable trading patterns, and we want to look for a flag in an overall trend. So flags are considered trend continuations. And what is a flag? A flag happens after the market has been trending here, as indicated by this big push to the downside. You can see the market in a short period of time dropped quite a bit, and then the market tried to rally higher, but this rally looked very weak. In a long period of time, when we compared to this sudden burst to the downside, the market was not really able to recover any ground, and the market just barely made its way higher. You can see here's even a rejection. So this huge pin bar and this huge candlestick wick was immediately driven down as the market tried to poke higher. We also added a daily moving average here just to get an idea of the higher time frame, and you can see the market is clearly trading below the higher time frame moving average. So overall, if we would look to a higher time frame, we would also see that the market is in a downtrend. So it makes sense to look for downtrending scenarios. And the idea of the flag is, first of all, you want to make sure that the market is trading out of the trend line, but the market should also clear the previous lows. That way you don't only trade a trend line. In my experience, trend lines can be a little bit more subjective. However, if you add a second layer of breakouts with a horizontal area and you really wait for the market to clear both, you can usually improve your entries quite a bit. And again, if you get in on a breakout, a potential stop loss, very simple, would be just to target behind the breakout level and the trend line. You don't want to make your stop loss too tight, because I wouldn't be surprised to see retests around this area after a breakout, and you definitely don't want to be taken out by a retest. But if the market breaks back into the flag, then I would be okay with being out of the trade, because then it really invalidates the idea of the flag. And you can see this is what happens. The market broke out. You can see, if we zoom in a little bit, you can see the market has a little bit of a wick here. So there was a small retest. So you really want to make sure that your stop loss is not too easily reachable. And you can see the market really sold off strongly. And it really continued what it done here. And it was able to continue the downtrend here. So when you read the classic technical analysis books, the head and shoulder is often listed as one of the most profitable and most reliable patterns. And again, it's very important that we put the head and shoulders into the right context. So a head and shoulders is often considered a trend reversal pattern. So we really need to make sure that first we're looking at a trending market. And if you want to increase your chances of finding a successful head and shoulder, put it and look for it at the end of or at a mature trending market. When the market has already been trending for quite a long time, then it really makes more sense to look for a head and shoulder. And what does the head and shoulder tell us? It tells us that from the left shoulder to the head and on the left side, the market made lower lows and lower highs, confirming the trend structure. And then when we look to the right, from the head to the right, here something seems to be changing, because the market is starting to make higher lows, which the market has never done previously. And this is our starting point for a head and shoulders. The entry and potential trigger point on a head and shoulders is when the market breaks the so-called neckline. And this is the area where the market, for the first time in this downtrend, is then starting to make a higher high. So at this point, we made a higher low already, and the breakout is confirming we have a higher high. So in theory, this is where new trends are starting, because if you want to look for an uptrend, the market is making higher highs and higher lows. And the head and shoulders is trying to help you get and find those trend following trades early on. And when it comes to stop placement, here it's pretty simple. You definitely want to make sure that your stop loss is behind the neckline. And some traders put it even behind the shoulder. Some traders even put it all the way behind the head, which in my experience is not really necessary. Could be a good starting place to start with the shoulder and then see how much wiggle room you have, how often is the price actually going against you. And for targets, we look left, and you could just look for, okay, where's the first resistance, where's the first support area, and that is usually a good spot to time your first targets. And you can see this is what happened afterwards. The market immediately didn't take off. And this is why I keep saying, don't suffocate your trade. Don't put your stop loss right at the area of your breakout point. Really give your trade some time and some room to develop, because price action is a very dynamic thing, especially if you trade maybe something that is more exotic, the exotic forex pairs, or stocks that are not as illiquid. You really want to make sure that your stop loss is not too close and the price really has some room here to develop. Trendline breakouts, trendline retests are next, and they are just so great. And again, let's try to look at it in the chart context. So what do we have? The market is making higher highs and higher lows. What do we have afterwards? the market is failing to make higher highs and higher lows. So here is a double top where the market failed to move higher. However, what else do we have? We have here a trend line to the downside, and within this channel or within this pattern that we are defining, what else do we see? Well, the arrow is giving it away, but there is a breakout buildup. You can see the market is not coming back to the previous highs. Here you can see we have two highs which are significantly lower. There are here this breakout buildup, and we have the perfect breakout. A good breakout is usually when the market is giving and showing you large candles. You want to see high momentum candles with a high momentum breakout. Again, stops could be placed, for example, just above the highs. In my experience, it's never necessary to put it all the way above here, although obviously if you do that, you are extra safe. However, nothing works 100% of the time. And stops are just our seatbelt, so to speak, in trading. So they help us reduce the risk, although you will never be able to completely eliminate the risk. So stop placement, definitely you want to protect your stop loss. So a good middle way would probably be here just above the highs. And for targets, you could use Fibonacci's, you could look left and right. And what do we have here? So after the breakout, you will often get a retest pattern. So sometimes, not always, will the market move away, pull back into the breakout area, and then perform a so-called retest. And this is something that many traders trade. It can be traded quite profitably, depending on the right strategy. But one way would be, for example, you go to a lower time frame, you look for, okay, where do we find a breakout there? And again, you can see the market really challenged here, the previous trend line, the previous lows. So that's why I keep saying, don't suffocate your trade, really put your stop loss away from the price action and give your trade some room to unfold. And then we could also even add a Fibonacci. So we add our Fibonacci from A to B. You can see we have a very nice 50 retracement. And we can then use for look for confluence. We have a previous resistance which turned into support. And coincidentally, it's also the 161 Fibonacci level. So that would make for a great target. And you can see the market moved into it in a very nice way. Not immediately was the market able to pull lower, and the market came back into the area, which again is why we really need to make sure our stop loss is not too vulnerable. And then this is how we can create a trading strategy step by step. So traps are a little bit like fakies, but there is one single difference, and the difference is on a trap is that you will often see the market actually closing above a previous high. Remember, the fakie, what we had is just a candlestick wick or a shadow poking higher, whereas on a trap, you will often see that the market is actually closing above the previous high and then immediately falling back into the range. This is where your trap is then obviously visible. So a trap can sometimes be used to get into a trade earlier on when you see that the market is here trapping the traders. Who is it the market actually trapping? The traders. The market is trapping the trend following traders who are way too late. The market is already trending higher here for a long time. So if you haven't been long, at this point, you are definitely way too late. And after such a strong trending market, it is usually not recommended to look for continuations, because the longer a trend goes on, the higher the likelihood that the market will reverse. This is especially true in Forex, which is generally considered a mean reversion market. In contrast, stocks are generally considered a trend continuation and a trend following market. So very important distinction here. And once you see that the market is trapping the traders, some traders even get in here at the high of the trap. Whenever you see that the trap has snapped, that is where some trap traders get in. Stops are very simply put above the highs, depending on the level of volatility. That's where you put it, and then this is how you play a trap. Sometimes you will see that a retest is happening after a breakout, so we are very nicely able to define this breakout level here, breakout, and then the pullback happens afterwards. We have a perfect deceleration signal, which is generally just the signal that the market is slowing down at the breakout level. That is a great signal that the market is actually not really too strong to push back into the range, but you can see the price action is really slowing down. And this is how deceleration and pullback traders then get in. And you can see we just look left, where's previous support resistance, and that is a good area for a potential target. All right, so now let's talk about triangles. And again, we want to look for a triangle at a trending market. So we have a very strong trend here, which then slowed down. And you can see when we look at the highs are coming down. That is not what you want to see in a trending market. In a trending market, that's not what you want to see. And especially after such a long trend, it makes it more likely for the market to actually reverse. And of course, we don't know that. This could also turn into a flag, right? Because a flag could be a signal of a continuation. However, the difference is that a triangle breakout will happen here to the downside, and this will indicate a reversal. Whereas if the market would have rallied here higher, that could have been traded maybe as a flag. So we never know before what happens. We always have to wait for the market to really clear one of the two sides. And then that depends on our setup and our the direction that we are engaging in. And you can see here the market broke out of the pattern, out of the range. You can see we even have some elements of breakout buildup where the market really stuck to the level here pre-breakout. We have a very strong breakout candle afterwards. And you can see stop placements could be here above the previous highs. You could even put it all the way above your trend line or the recent highs, really up to you. And looking left, you can see we have a potential support area. This is what some traders refer to as liquidity gap. So the market has no problem usually, or very few problems usually, covering such an area, because there's just nothing to stop price from falling. There's no support and resistance. There are no real swing highs and lows here. So this is usually a very easy area to cover. Much harder, much easier than actually to trade through something like this, where everywhere there's support and resistance. The market has previously bounced here everywhere. So this is something that when you see that around your trade, that is sometimes when you can really stretch your target and go for an even higher reward to risk ratio. You can see what happens afterwards. The market moved lower, tried to pull back, gave you a perfect 61.8 retracement. And you can see the previous blue zone that we marked is just a little bit beyond the 200. So if you are looking for a target, maybe a good idea would be to target to 200, and that is where you often see a reversal. And you can see the market just briefly touch the area after a long struggle though. So a 200 level is often used by a lot of traders for targets, and something to maybe explore if you like using Fibonacci's like I do. And last but certainly not least, the triple tap. The triple tap, whenever I talk about it, people get very interested, and I think rightfully so, because it's a very, very interesting and important pattern. And again, what do you want to see in a triple tap? First of all, it makes sense to look for it in a trending environment. So here the market has been trending lower. And then you can see the market seems to be slowing down and the trend is not as strong seemingly. You can see from here to here to here, the lows are becoming weaker and weaker. Whereas previously you can see some very big bearish drops. Suddenly the drops are becoming smaller. Here just basically one red candle and the market is not able to continue lower. So that is a great indication that the market is actually slowing down and that the downtrend here is not as strong anymore. We can then look for breakout levels. So we look for flip zones, previous support turning into resistance, because that is then what we are using for our breakout level. We really want to make sure that the market is clearing here this area, because that would indicate for the first time that the market is actually making a higher high. Whereas previously the market only made lower highs. This would be a situation where the market is making a higher high. And you can see this is what happens. The market pulled away, pulled outside of the range. And then you can see again, it's not as easy and not as simple. The market did take quite a while to actually follow through. However, that's why we have our stop loss placement, and that's why we use stops. We want to make sure that our stop protects our position. Where would our position be protected? When we look at a potential entry, you can see definitely below the lows. Some traders even put it below the absolute low of the downtrend, which gives you even more protection. As much as you get in trading, nothing works 100%. I can't really stress this enough. And then you can really see how the market came back to it, tested it multiple times. That's why you always want to make sure your stop loss is really out of the way and not in any areas where the market has previously shown a reaction, because those areas, frankly, just pull in the price continuously going forward. So you really want to make sure that your stop loss is out of the way, and it's just one thing less to worry about. And then that's how you would approach it. And that's it. And before you sign off, off. Here again, a quick reminder for our special bundle, 4 trading courses for the price of 1. Or if you like a little bit more of a hands-on approach, look into our Forex mentoring group, where we have a live chat room, all the trading courses, and also live webinars every day of the week usually. So I look forward to hearing from you, and until the next time, happy trading.